Welcome everyone to Investing for Generational Wealth. Let's dive into the world of expert financial insights and strategies. Before we begin, a quick disclaimer: we are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest, so perform your due diligence before making any financial decisions and, of course, consult your CPA and your attorney before beginning any investments. Now, here is your host, John Lai.
And welcome to today's episode, 4 strategies for passive investors for 2023 and 2024. Today's guest is Daniel Holmlund, whom I've known for a couple of years now. Daniel's vision has led him to create Good Samaritan Capital, a private real estate investment firm that specializes in multifamily acquisitions. Good Samaritan has quite an impressive track record, having closed on $168 million of assets under management, AUM, which includes over 3,000 units in properties spanning 9 states. Today, Daniel will be speaking to us about strategies for 2023 and 2024 and beyond. Thanks for being with us here, Daniel. I just gave a bit of background on your experiences. Could you give and provide more detail on how you got to where you are today?
Sure. Thank you for having me here, John. It's a pleasure to be here and pleasure to talk to everybody that's here. If you have questions, feel free to put them in the chat, or, I mean, if you're live, there's few enough people, we could even just have you take yourself off mute. But so my name's Daniel Holmlund. I founded Good Samaritan Capital in 2018, but I've been a real estate investor since 2002. Mainly, first of all, working in single family homes, and then in hard money lending for a period, and then into apartment complexes. Starting in myself, I started investing in them in 2016, and then I realized I enjoyed investing this way so much that I went on to found Good Samaritan Capital in 2018. But today we're going to talk about 4 trends to watch in the upcoming market, and the market is moving right now. So, John, was that a good enough introduction? Do you want me to do anything more?
That is great. And go ahead and launch into your presentation. We're definitely interested in those trends.
Okay. So full disclosure here, Good Samaritan Capital has the GSC Growth Fund, which is a private equity fund. And these are the 4 areas that we're telling our investors to look at, and in particular where our fund is looking to place capital. And so, of course, the first one is that here in 2013, it's been expected. Interest rates are going up. Distress is coming to the commercial real estate market. And if you look at the Wall Street Journal or any of the financial news publications, you'll see a lot of scare stories about office real estate, and office is going through a scary downturn right now. Morgan Stanley says that valuations in the office space could fall as much as 40% during this year and continuing on into 2024. Some other groups have suggested that it could be even more. And so you can see here in office space and in downtown activity, there are, of course, winners and losers like there are in any sector of the economy. And Chicago, Detroit, Portland, where I live, and Cleveland and San Francisco have all been going through rough times in terms of office space. And a lot of this is, of course, due to the pandemic, an effect of the pandemic. During the pandemic, a lot of companies discovered that it was cheaper just to have their employees work from home. And even if there's some drop in productivity, which there sometimes is and sometimes there isn't, depends on the person, but it can be more cost effective than leasing out downtown's, valuable office space. On the other hand, there are some winners in this group as well: Salt Lake City, Bakersfield, Columbus, Fresno, and Omaha. So it's interesting. There's 2 cities in there, Bakersfield and Fresno, that are California based. And one thing that we saw during the pandemic was there was a strong outflows of capital coming from both coasts, both the California coast and the New York side of the country, and people basically started moving to where they wanted to live because they could work remotely, in large part, or for political reasons during the pandemic, or for whatever reason. There were large outflowings of people in areas of the country where evaluations and property values were quite high. And so we've seen a little bit of a rebound effect in the last year or so. Areas within New York have actually started going up again as people are coming back together and working on site at their companies together. So in some areas, we've seen rebounds. So in California, I actually do know that in New York, there's been a little bit of a rebound. But in some cases, that rebound didn't necessarily go to the same city that the downturn came from. Salt Lake City, Columbus, and Omaha are big beneficiaries of this space recovering fairly well. And so you can always find horror stories, and they're out there. But what we're seeing right now is the effects of the pandemic and how that's moving capital and jobs around the country. The other big piece of the puzzle here in commercial markets is that there's a lot of debt that's maturing both this year and by 2025. And so what happens in the commercial space is that if valuations fall and your debt is maturing, you're in a situation where, of course, your property is underwater. And so with a lot of debt maturing and with variable interest rate loans, which is a significant portion of the market, this is causing a problem for a lot of commercial buildings that aren't going to be able to refinance. So construction loans are one area where this is a problem. You actually see this a lot in multifamily properties. So in multifamily properties, the gold standard for your debt is going to be Freddie Mac and Fannie Mae. And they're the government agencies that will give you low interest rates and good terms. They'll usually give you a couple of years of interest-only payments so that you can focus on renovations or divert some of your cash flow to other activities. But the problem with them is that they'll only deal with you if your occupancy is over 90%. So if your occupancy is under 90%, which is the case in a lot of multifamily apartments, because why are they selling? Well, they're selling because they're underperforming and somebody else thinks that they're going to come in and run the property better. So oftentimes, if your occupancy is under 90%, you're going to be forced to go the route of getting either a bridge debt, or if you're building something, a construction loan. But a lot of the value add multifamily is financed through bridge debt. And bridge debt is financing which is a little more expensive than Fannie Mae and Freddie Mac. But the point of it is to give you the ability to acquire the property and to renovate the property and get the occupancy up to 90% so that you can then refinance into a Fannie Mae or Freddie Mac long-term loan with a fixed interest rate. One of the downturns or the downsides of bridge debt is that it's a variable rate debt usually. And so that has caught a lot of people who invested in multifamily because they weren't able to renovate the units fast enough in order to increase their occupancy up to 90% and refinance before the Fed started raising the interest rates. And so that's left quite a number of groups in a precarious situation. And we're seeing that play out right now in multifamily. The market cap rates are starting to uncompress and to go up a little bit. And there's some distress out there with properties that are, just not able to make their mortgage payments because the interest rate's gone up so high. So that's the floating and variable rate loans. And of course, the low debt service coverage ratios. This is where the amount of debt that your property has is high enough that the ratio of your debt to income or your income to debt rather, is considered to be low. Most mortgage companies want to see this at 1.25 or better. And if it's lower, it's considered to be an at-risk property. Another portion of this is that because there's distress within the market, the banks and particularly the lenders often will become much, much more picky about who they're lending to and how much they're giving to them. So in the last year, we've seen most lenders whereas a year or a year and a half ago, you could get 75% of your financing or loan to value ratio of 75%. Now it's pretty common to see 65% loan to value ratios. So it's getting harder to borrow that money. And then that means that, of course, any investors that are trying to purchase a building have to go out and either raise that capital or put it in themselves. And so banks are making sure that they're in more secure positions by lending less to each project. And overall, transactions within the commercial space this year are down, depending on who you ask, 70% to 80% because of this fact, because lenders are simply not lending as much. All right. So what does this mean for multifamily? It means that rent has been going up incredibly during the pandemic, is now starting to soften. And so you see this whipsaw effect coming from the pandemic here, where at first rents went down and then people started moving around a lot and it caused a huge rent boom. And now we're seeing the whipsaw effect come back down in most areas again. So because lending is becoming more difficult, it's becoming more difficult to raise rents at the same time. So rents are pulling back a little bit. And of course, there are winners and losers in this as well. Another big component in multifamily and in all commercial spaces right now is that operating expenses are on the rise. And I think everybody knows this. You know, inflation has caused prices to go up incredibly all throughout the country. Most of our properties have seen increases in operating expenses anywhere from 13 to 15% since the pandemic. And so these expenses right here are rising, and the rent, the income portion is softening. And so you're getting to a period where you're running a lot of properties that are cash flow poor, or at least there's not a lot of cash flow. And so you've seen a lot of properties and a lot of investments stop distributions because this is tightening so much. All right. The second long-term trend that I want to talk about here, actually, why don't I stop at this point and take questions? Are there any questions?
If you have questions, raise your hand, because I believe I need to unmute you, but raise your hand if you do have questions, or put them in the chats. I don't see any questions so far. I do have the one question, which I think you'll get to, which is about both I think the most recent consumer price indexes show that inflation will be softening. I mean, I think it'll still be persistent, but it'll be softening. So that has impact on long-term interest rates, potentially also moderating, right? Do you think that'll be a benefit for commercial real estate, or do you think that will take a little bit of time to actually catch up?
I think it's going to take quite a bit of time. I mean, for the past decade or so, our interest rates have been near zero.
Mhm.
And so that's historically low prices. Right now, the way we're actually more towards normal interest rate prices currently right now. But the problem is that for so long we had such low interest rates that businesses have shifted over their business models to basically adapt to those low interest rates. And now that we have somewhat normal interest rates, you know, it's causing some pain in the market. My opinion is that first of all, inflation is softening, and we can see that again from the pandemic. There's a whipsaw effect, just like rent prices, just like property valuations, just like a boom in construction and the absorption of that construction. If you look at all of those charts, they've all had a whipsaw effect since the pandemic. And interest rates are the same way. We had them go way up last year, up to I think the high was 9.1%. And now they're coming back down. They're in the 3s and 4% right now. But the problem is that consumers right now have over $1 trillion of commercial or credit card debt. Our government is at all-time highs for its debt. And anytime there's higher debt, that tends, sorry about that. that tends to indicate that inflation is going to remain high, because it's in the best interest of a person who is borrowing money to have that money get paid back with cheaper dollars. And so inflation is probably going to remain high for quite some time, is my opinion. And I'm not just through 2025. Some commercial property owners out there, I've heard the mantra. I think Neil Bawa mentioned this, and I've heard other people say it too. But their slogan has been "Survive till 25." And while I think that's going to be where we're going to see a lot of the whipsaw effects, I don't think it's going to stabilize at a lower interest rate level for a long time. I would say the foreseeable future.
Got it. Okay, thank you for that. That's great.
Yeah, did I just go through all my slides here without showing them? I think I did here. So the Fed rate right here. Yeah, there's an interesting. This was an interesting chart that I pulled from Yardi Matrix, and it actually shows inflation as a percentage of persistent inflation versus transitory inflation. And this was an interesting chart for me because the transitory effect, which was highly, talked about by the Fed, and is not being talked about anymore because, because a lot of people don't agree with how they handled it. But this portion of inflation, you saw the whipsaw effect quite a bit. And here, the persistent portion of inflation is showing that it's coming down and stabilizing, but it's stabilizing at a higher level. And this may continue to go down here. We'll see. But inflation is definitely looking like it's going to stabilize at somewhat of a higher level. And these are more along market norms in any case. Here you can see that the producer price index, there's an interesting relationship between the producer price index and the consumer price index. The producer price index tends to follow the consumer price index, or to indicate what the consumer price index is going to do a couple months in advance. And so you can see that while producers' prices are going up here, there was at some point an inflection point. And this was right about where a lot of our supply chain issues were starting to be unsnafu'd, I'll just say. But supply chain issues were improving. And so it came up and it kind of peaked, and now prices are going down. But this is still, much higher than it used to be. And so the overall consumer price index is trending upwards as well. I already mentioned this, public debt. When you've got a lot of debt, it usually is to your advantage in terms of economic policy in order to keep inflation higher. But it's balancing, it's a balance between making sure that the economy functions and making sure that inflation is high enough in order to ward off a lot of, interest rates are high enough to ward off inflations. So unfortunately, I think that if you look at a chart and think of the inflation rate versus the interest rate as kind of a crossover, or having a crossover point, there is a point where you can bring inflation down by raising interest rates, but you're never going to recover the economy quite to the point where it was. So there needs to be an equilibrium between those two, and that point isn't necessarily at where our economy used to be. Okay. So I guess I did go through both of my talking points on that before I showed you the slides. My apologies for that. Trend number 3, housing undersupply. So this is an interesting, and this is the most, this is really the reason why I think investing in real estate over a long-term basis is still an incredible investment opportunity, because we're seeing a lot of distress in the market right now. A lot of people who didn't position themselves correctly. But even though we have some trends that seem to be causing disruption that are causing disruption within the market, a lot of the longer term trends that we expect to be persistent for, the next 10, 20, 30 years are in favor of real estate evaluations or real estate prices rising. One of the biggest ones is that we have a housing shortage. This was brought to an incredible point in the pandemic. I think in my hometown of Portland, and I'm out in the suburbs, the average time that a house remained on market during the pandemic made it all the way down to 2.1 days. And it's more common to be on the market for 2 or 3 weeks or so would be kind of a norm, or even higher potentially. But during the pandemic, the shortage was so exasperated that time to market for a residential house made it down to 2 to 3 days. And that was happening not just in Portland, but nationwide. We were seeing similar statistics. The National Apartments Association put out this statistic last year that said by the year 2035, we're going to be undersupplied by 4.3 million, where we need to build 4.3 million units in order to reach supply by 2035. This means that there are going to be a lot of renters out there. And unfortunately, it's true also that as housing prices continue to go up, houses become more affordable. That means that renters are going to increase because there's only three options, right? You're either renting, you own your place, or you're unhoused. You're living homelessly. So as prices go up in the housing area, that's going to cause increasing demand within the rental markets as well. All right. And this was an interesting chart that I found here. This shows the housing shortage between 2012 and 2019, and which areas of the country had more severe housing shortage problems, like you see down here in the California area, and over in some of our major cities up here in Utah, in Denver, and Minneapolis here, Portland, Oregon. But this is kind of an interesting chart that shows where a lot of the extra demand in rental prices and where housing shortages are prevalent. One interesting statistic that came out of this is Texas, Florida, and California account for about 40% of the demand that that the Apartment Association mentioned by 2035. So these are going to be three areas that will continue to be hotbeds for investment.
You have on that previous chart, the same chart between 2019 and 2023, the exodus of either renters.
I wish I did. I looked around a lot for it, and it does. There's two. I mean, obviously the pandemic changed the trends that were going on right here, and so these trends are pre-pandemic trends. The pandemic in a lot of ways really just accelerated a lot of the trends that were there in terms of housing shortages. I don't have that data, but I did scour the National Apartment Association site looking for that data, though.
Got it. Okay.
All right. And then here you can see, obviously, we're having big rental increases here versus home ownership prices. Home ownership unaffordability always tends to precede rental increases. But with a higher degree of mobility that happened during the pandemic, this shot way up. So in Florida, I know that we have a property down there, and the whole market since the pandemic has gone through just amazing amounts of change. Prices on average, this property is in the Sarasota, Florida area. On average, there have gone up by 50% in terms of rent. Wow. So rent has gone up 50% in that area of Florida, and so there are some areas that, in my opinion, are just increasing too quickly, and we're going to see long-term demand, but short-term leveling off, and people that have purchased at too high of a leverage point and are going to see some pain in these areas as well.
I have a question on both insurance, because you mentioned Florida, and so I wondered in California too, insurance, the large insurance providers. Now this is primarily for auto, but I wonder if it's going to affect homeownership as well as multifamily as well, that they're pulling out of these states where there is a lot of demand for homeownership or really housing in general, and how that's impacting kind of like the investing perspective of
Yeah,
multifamily.
yeah, that's one of the largest expense increases that we've seen is the insurance rates, particularly in Florida. Florida insurance rates due to hurricanes and other phenomena down there have actually tripled since the pandemic. The rates on insurance have tripled,
That's
which
crazy.
is incredible. In Texas, it's up almost double. In other parts of the country, it's not quite that bad, but insurance is way up this year, all over the United States.
Yeah.
All right. So just a quick summary here. We're going to see distress in the market in 2023 to 2025. The mantra again, survive till 25. Some people aren't going to survive, and that's where you're going to see these distressed properties. Long-term trends like housing undersupply will continue to be good, even though interest rates are up, and that's going to cause some decompression of cap rates and property evaluations will come down in the near to midterm. I think longer term trends are going to continue to drive prices higher, which is also going to continue to drive rent demand higher. So there's a limited supply of these. And one thing that I've noticed in the market right now is that having broker relationships is absolutely key, because there have been a lot of people in the market that have not been able to close on properties, or for whatever reason, brokers have just had their time wasted by people who bid on properties and then aren't able to actually follow through with the acquisition. And so you're finding that broker relationships are tending to consolidate on larger firms that have key relationships already established in the market. A lot of properties are going to need injections of gap funding. Now, gap funding is basically where your expenses are getting higher than your income, or let's say you have a large capital expense, like you need to replace your roof. Gap funding is going to be an opportunity here in the near term, because there are going to be a lot of investments that have had their cash flow squeezed, and then if you add a large expense on top of that, suddenly you can't pay for that expense out of your operating income. And so you're going to need to go borrow or raise that money somehow. And that leads to a lot of the people in the market that are talking about either, second mortgages or mezzanine financing or preferred equity. And I think I wasn't going to show this slide, but I've got a good slide down here on that topic. Loading. Okay. So what happens here is that you've got your senior mortgage here. This is your bank mortgage. And then you have all your investors that are up here in the common equity. And if you have a gap due to a large expense, you're going to need to come in and bring more money into the capital stack here. And that can either come in as equity, in which case it's probably preferred equity, or mezzanine debt, which is after the senior debt. So the order of repayment here is the senior debt gets repaid first, then your mezzanine debt, then your preferred equity, then your common equity. And so the danger of gap funding is that investors that are up here may have debt or equity brought in that's senior to them in the position of being paid back. And so what can happen is if investors are borrowing too much money, that can cause returns to be diminished, or potentially even loss of capital up here for the LP equity investors. Let's see.
Daniel, you might go over this because I see that you have a section on strategies, but for retail investors, so for a lot of people in this audience that are not either GPs or sponsors of syndications investing in multifamily, they're retail investors that may want to take advantage of opportunities in the space. What would you recommend? And how can they get into something like a debt financing or participate in that.
Yeah. Well, so there are funds out here that are starting more and more to specialize in these two areas, either debt funds that are providing mezzanine debt or preferred equity.
Mm-hmm.
And so here's an example of a preferred equity. Um, so a lot of times these funds are looking to place about $1 to $3 million, which can sometimes be problematic because if you just need to replace a roof, that might only be 300 or 400,000, depending on the size of the roof, um, on a commercial building. But the nice thing about preferred equity is that you actually get uh, contractually obligated payments. So with common equity, with LP investors, basically whenever there's excess cash flow, that gets distributed. Well, with preferred equity, it's contractually obligated, just like it is contractually obligated to pay your mortgage each month. The preferred equity has contractual payments as well. And these are often in the range of 10 to 14%. And so one thing you can do is look for commercial funds that are specializing in making these sorts of placements. There are a lot of groups out there that need some sort of short-term financing here. And if you can get yourself into a position that gets paid back first and you're getting contractually obligated payments that are often better percentage-wise than the LP investors, then that's not a bad place to go into.
Yeah.
And from the point of view of the investment there, that might be what they need in order to replace that roof or finish the last 20% of the units that they're trying to renovate, or do whatever sort of value add or construction project they currently have underway. So that borrowing that money or giving out preferred equity will get them to that place where they can begin also paying their limited partners as well.
Yep. Yeah, that's great example of how investors can participate. I actually am participating in a basically not preferred equity, but mezzanine debt,
Yeah.
and getting that double digit percentage. So that's nice.
Oh, are you going to shout out to who you're investing through, or is that?
We can take it offline.
Okay. All right. Let's see. So yeah, more of the takeaways. And I think I'll probably finish on the takeaways here. But the takeaways are that, from a high level, there's distress in the market. The long-term trends are still positive, but you have to go into it with a group that really knows what they're doing so that they aren't, wiped out in short-term distress. And then there are more interesting and more creative financing solutions that are starting to arrive, like preferred equity, like mezzanine debt, that weren't focused on as much traditionally because we're in a more difficult market now, and so more creative financing is happening. Debt assumptions. One interesting point with debt is that at least in the residential sector, I was shocked to find this out. 40% of homes in the United States are owned clear and free of debt. And if you go up to 60% of the homes, 60% of the homes have an interest rate of 4% or less.
Wow.
And so this is one of the reasons also that, transactions have slowed down, both residential and commercial, is that, and going back to having a decade full of, very, very low interest rates means that now that interest rates have risen, there's a huge section of the economy or of the housing market that is not in distress. And so, one counter argument to the idea that we're going to have a housing crash, one thing you have to have in order to have a housing crash is distressed sellers. And right now, if 60% of the market has got an interest rate of 4% or lower, it's going to be really hard to find distressed sellers, at least enough distressed sellers. Now, there are, let me scope this a little bit here. The distress that we're seeing is like 5%, a very small percentage of the market. The larger percentage of people that have got good fixed long-term debt are not going to see that distress. And so the idea of housing, bust it simply requires more distressed people than we currently have in the market. So that's one reason why I don't tend to believe the naysayers who say that we're going to have a housing.
Yeah, and certainly not in retail housing. I mean, residential
Yeah,
housing. I think you're right.
there's a large undersupply right now.
Exactly, and I think that's causing a lot of the I guess the disparity between supply and demand. There's a whole lot of demand. Unfortunately, there's also high interest rates, but there's very, very low supply, and so that's what's keeping the housing prices high. Whereas in the commercial real estate realm, both multifamily less so, but more the commercial real estate, as in actual buildings that are being unoccupied, or the WeWorks of the world, which are not being as successful in leasing their office space. That's where there might be opportunity. Unfortunately, for retail investors, that's typically not accessible.
Right. So I see there's a question: how do we find these groups that Daniel's referring to? Yeah, unfortunately, a lot of it is there's a couple of different ways that the Securities Exchange Commission allows investment groups to advertise. And some of them are not allowed to advertise because they accept unaccredited investors. If you find the ones that are advertising, they're advertising on podcasts or social media. A lot of those are 506c based, and they're for accredited investors only. So honestly, the way that I would do that is I would join a real estate club and just ask people who they're investing with. And I'll throw out my shameless plug here for the Alternative Investing Club, alternativeinvestingclub.com. We meet every Friday. Yeah, it's a lot of word of mouth, to be honest.
Yeah. I can definitely confirm that. The only other option, not only, but there's another option, which is the funds that Daniel talks about. I mean, the Blackstones of the world and others do have these debt funds that you can invest in. There are minimums. Again, work with your investment advisor, your RIA. They might have access to those funds, and then they may be able to bring you in at a lower price point.
Yeah. Although honestly, a lot of if you go with registered investment advisors, a lot of them are through Schwab or larger financial organizations that don't tend to invest in real estate because they tend to want to concentrate the money on Wall Street rather than putting it out throughout the nation on Main Street. So it can be hard to find them through advisors as well.
And the other thing to say about working through a Blackstone, I mean, obviously they take their cut as well, right? So
yeah.
And so you're not going to see necessarily all the 10 to 14%. You're going to see a portion of that.
Yeah. All right. And so I wasn't sure. Am I allowed to mention my company's name? I mean, I guess it's up here in the in the logo, but
definitely, yeah. Mention your company's name.
Okay.
Mention from an educational perspective how you think your company might help, and then if they want to know more information, they can reach out to you.
Yeah. So we're a private equity company, and our fund is called the Good Samaritan Capital Growth Fund. And we're at goodsamaritancapital.com or invest.goodsamaritancapital.com.
Okay. And if you wanted to find out more information about Daniel and Good Samaritan, feel free to reach out to them. I do have some follow-up questions, but I do want to make sure that we're addressing other questions that people might have. So if you do have questions, feel free to raise your hand again or put them into Q&A. If you raise your hand and want to actually speak, I can unmute you. But the questions I have, Daniel, for you. So you focus primarily when you do, it sounds like you have private debt as well, but you have traditionally focused in multifamily real estate. In this market, again,
and industrial.
In industrial, okay, got it. In this market where there's, I guess, softening inflation, there is inflation. and then relatively high interest rates. Who knows when those are going to come back down? From a asset class perspective, what do you like? And it sounds like industrials something that would be useful, would fare well in this market. Private debt financing obviously would fare well. What are your thoughts on that?
Yeah, the reason why we liked industrial quite a bit is that with the supply chain crisis that happened during the pandemic, there's been a lot of push to onshore a lot of the production that had traditionally been overseas, and so that's caused a boom in industrial prices. And then the other thing with that industrial is that, multifamily, you have year-to-year contracts usually. In industrial, it can be 5 years or 7 years, and so you have much longer contracts that you can really lock in for a long period of time. That just makes it more stable. Um, and then I'm sorry, what was the other part of your question?
And asset classes. So like
Oh,
uh,
wow, yeah, right. Asset
in this
classes.
environment. That's right.
So in this environment, I mean, since 2021, Good Samaritan Capital, our mantra has been flight to quality, and so we like A minus and B plus assets, assets that have, a light value add, but are really, nicer looking assets. And so we've tended to partner with large groups that own a lot of this type of asset. We just closed a deal with Lone Star Capital, and it was a Class A property. The
Yeah.
thing that made it worth investing in is we got a property tax exemption, and so that cleared out 30% of our expenses right there with the property tax exemption.
That's nice.
And so if there are opportunities to find high quality um, product or high quality investments, and there's a business reason for doing it, like tax exemptions or whatever it is that you can use to either minimize your expenses or increase your revenue. um, Higher quality properties are what we tend to like. Class C properties, which a lot of multifamily people are in, tend to be a lot of work, and you get a lot of just turnover and extra expenses in them. And so we tend to like to work with higher quality renters.
Got it. Okay. Um, and the topic of this particular session is passive investors, and a lot of the potential investors in the audience are passive investors. They have day jobs. What should they be thinking from a strategy perspective and investing perspective? What should they be looking out for to remain passive, but also to earn the high returns on potential opportunities?
Yeah, I think that you need to find companies that already have, of course, established track records, and they've performed and outperformed. I think that knowing the net worth or liquidity of the people that you invest with is very important. There are some operators out there that I'll not name, but they have a very impressive looking portfolio. But if it's over leveraged, then when one has a problem, that could domino to other properties that are out there. And so your investment might look good, but if they have other investments that don't look as good, that can cause a domino effect that will affect your investment. So knowing that the sponsor has enough um, capital in order to handle situations like that is, I think, really important right now.
We do have another question. What are the ballpark numbers, dollar numbers are we talking about in terms of investment from the point of view of multifamily industrial in contrast to retail?
I'm going to guess that you mean how much are individual investors putting into these?
I think it's whoever asked the question, if you want to clarify, or you can come off mute as well. Just raise your hand and then I can unmute you.
Yeah, so a lot of funds ask for, $50,000 as a minimum investment. Okay, yeah, yeah. So like I said earlier, when there's distress in the market, there's definitely more creative solutions. So I've seen there's a group out there called TribeVest that basically gives people software tools. They're a software provider that lets people put together their own LLCs and all the voting that you need to do within your LLCs to have, say, 10 people come together with $50,000 and buy, put a down payment on something for 500,000. So there are ways of reducing the amount that you need to go into a fund, or a syndication. 50,000 is very common. I've seen more 25,000s recently. So that tends to be your ballpark.
Yep.
But there are more creative people out there currently than there have been in the past.
Yeah. I have some questions that we always ask our interviewees. So I'd like to ask some of these of you.
Okay.
The first one is describe some of the failures you've had in the past, what you've learned from those failures that are teaching moments for others.
Yeah, so during the pandemic, we closed on a property in Memphis, Tennessee, in January of 2020, and pandemic came along in March of 2020. And one of our big problems is that we were still in the process of ordering materials for the renovations that were there. And due to the pandemic, it took us 4 months longer than we thought it would take to get the materials. And unfortunately, and of course, the longer it takes you to begin your renovations, um, that's time that you're not putting renovated units onto the market and capturing that rent, which eventually goes through to your investor. So the faster you can renovate your units, the higher your investor return is going to be. And if your project, is elongated, that means that your returns are not going to be as good. So, and then when we did get our supplies in, half of our construction crew went down with COVID, and then about 3 weeks later, all the rest of them had it. And so there was like a 6 month delay in our project there. And what that ended up doing is it meant that our cash flow was very tight. We ended up holding that project for about 30 months, and we didn't give a distribution at all during those 30 months. But when we sold the project and it was all completed, we gave a 1.4 multiple. So if you put $1 in, you got $1.40. It was actually $1.38 if I remember right. $1.38 out. So sometimes you can get properties that aren't giving distributions, but can give you a good return on the back end when it's sold or refinanced. But if you're not giving distributions, that usually, indicates a low cash flow situation where you could have problems.
Yeah. A similar question, if you had to go back 10, 20 years to a younger version of you, what advice would you give to yourself, knowing what you know now? And maybe a piggyback question to that would be for investors that are just starting out, like what advice would you give to them?
Well, right now in the market, I would invest with people that have long track records of giving distributions, or if their strategy is to, flip it and give their return on the back end, have a long history of doing that. I would simply stay with larger players, honestly, in the current market.
Yeah, that's great advice. And then a similar question to that, for those that are just getting started, what do you think is a fallacy that, when you started, you thought was the truth or true?
That you can't lose money in real estate. You absolutely can. And going back to that capital stack, if your property is borrowing excess money, or if your company is borrowing excess money, or if your government's borrowing excess money, all of these things are going to cause financial problems.
Yep.
So
Agreed.
sometimes it's necessary to keep the project afloat, but it's certainly an indication that things are not healthy.
Got it. How do you give back to your community?
Oh, well, at the Alternative Investing Club, we have a speaker every week. And that's one of the things I really pride myself on. We do 49 events per year. So we do it every single Friday, except for next week. We don't do one after Thanksgiving, and we usually don't do one Christmas week. But yeah, I love just having a club where we, very similar to this, where it's just educational advice.
Right, great. For those interested, what's the best way to reach you and to learn more information about what you do?
Daniel at GoodSamaritanCapital.com.
Perfect. Well, if there are no more questions, and I don't see any questions in the queue, I wanted to thank you very much for your fantastic presentation, Daniel, as always. To learn more about passive investor strategies, feel free to reach out to Daniel. And we'll include his contact information in this description for this webinar and this episode and podcast as well. Thanks for educating us on the 4 strategies for passive investors for 2023 and 2024. We learned a ton of great information. Thanks again, Daniel, for taking the time out of your busy schedule to speak to us and to our audience. Don't forget to like and subscribe to our webinar and podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content. And thanks again, everyone. And until next time, keep learning to invest for generational wealth. Thanks, everyone.
Thank you.
Bye-bye.